Otis earned a 3.1% operating margin building and installing elevators last quarter. That is unusually thin. Its service business, on the other hand, delivered a 25.1% margin. Both numbers are deliberate. The gap is not a coincidence. That pattern suggests a financial model engineered around a specific trade-off. Otis makes elevators. That is not the business it's in. The business is the maintenance contract that follows. The elevator is given away to get onto it, and the annuity is rented, not owned. Otis operates two distinct business segments. New equipment, design, manufacture, sell, install. Service, maintain, repair, modernize, and not just Otis machines. Service also works on elevators built by competitors. That understanding is critical because the numbers reveal the strategy. New equipment accounts for 35% of sales, but only 9% of profit. Service delivers 65% of sales and 91% of profit. The margin story is lopsided, and about 71% of all revenue comes from outside the United States. The scale behind those numbers is massive. Otis maintains roughly about 2.5 million units worldwide. That fleet is serviced by 37,000 mechanics, working out of more than 1,400 branches and offices. And about 1.1 million of those units are connected through Otis One, a digital monitoring platform. The point is this: the installed base is the asset. Everything else is how you build it. An elevator is unlike almost any other product. It is a regulated safety device. It must be inspected consistent with local regulatory needs. It is fixed inside a building that cannot function without it. That combination, a safety device, a piece of machinery, a single point of failure, means that one transaction creates a permanent obligation. The elevator wears out slowly. As it ages, Otis sells modernization. That can range from interior finishes to replacing the machine, the ropes or belts, the safety systems, or the entire car. The maintenance buyer is frequently a different party from the original purchaser. A building owner, a facility manager, a housing association, not the developer who bought the elevator. The cash character of this business is remarkable. Customers pay in advance. Look at the balance sheet. Contract liabilities are $2,611 million. Inventories are just $613 million. Customers pay before the work is done. The annuity is rented, not owned. It is not a product sale. It is a stream of payments secured by a machine that cannot be moved. The physical reality drives the financial one. An elevator is a captive asset. Once installed, it is the building's only vertical artery. It must run. It must be safe. And the party who signs the maintenance contract often has no choice about which brand of elevator sits in the shaft. They simply inherit the obligation. That is why the installed base is the asset. The elevator is the hook. The maintenance contract is the line, the sinker, and the reel. The arithmetic implies that a new equipment sale at a razor-thin margin is rational if it locks in 91% of segment profit for the life of the building. And that life stretches far beyond any warranty period through decades of inspections, repairs, and eventual modernization. The elevator does not leave. The building cannot replace it without demolishing the shaft. So the relationship is not a transaction. It is a permanent structure. And that structure is built on a balance sheet where customers pay ahead $2,611 million in advance against inventory of just $613 million. The business collects before it spends. That is the mechanical heart of the annuity. But that heart is under pressure. In the restated figures for FI 2023, the new equipment margin stood at 6.6%. A year later, it had fallen to 6.1%. By the full year FI 2025, it was down to 4.8%. The fourth quarter of that same year came in at 3.6%. And by the second quarter of 2026, it had hit 3.1%. That is a quarterly figure, not a trend line, but the direction is unmistakable. Segment operating profit in that quarter was just $40 million from new equipment. That is a thin cushion for a business that relies on volume to seed the service base. The orders that determine future volume tell the same story. In Q2 2026, new equipment orders fell down 5% at constant currency. The Americas posted low teens growth, and EMEA managed low single digits. But Asia-Pacific, the engine of volume, recorded a decline of more than 20%. Within that region, China alone saw orders drop by a high teens decline. Since China accounts for over half of global new equipment unit volume, that is not a regional blip. It is a structural shift. The dollar figures confirm it. New equipment net sales fell from $5,812 million in FY 2023 to $4,989 million in FY 2025. Now, consider the textbook model. The thesis is sell the elevator, then service it for decades. If new sales are shrinking, the pipeline of future service units should be shrinking too. But that is not what the numbers show. At the end of 2024, the maintenance portfolio stood at about 2.4 million units. At the end of 2025, it had grown to about 2.5 million units. The portfolio is expanding even as the new equipment line contracts. That is the complication. That pattern suggests the business is adding service units without selling new elevators in proportion. Something in the model is breaking the expected link between sales and service. By FY 2025, new equipment contributed only 9% of segment operating profit, while service contributed 91%. The machine that feeds the annuity is becoming a marginal earner. Meanwhile, the service margin rose to 25.1% in FY 2025 compared to 24% 2 years earlier. The arithmetic implies the annuity is getting more profitable even as the cost of acquiring it becomes less efficient. The arithmetic implies that Otis is no longer relying on new equipment sales as the primary driver of future service revenue. The portfolio is growing, and where that growth comes from is the question this raises. What is visible is a structural shift in where the profit is made. The model is not broken, but the numbers are diverging. The consequence is not existential. It is structural. The fuel that feeds the installed base has changed, but that link has frayed. From the end of 2024 to the end of 2025, the maintenance portfolio grew from about 2.4 million units to about 2.5 million units, a net addition of roughly 100,000 units. Yet over that same period, new equipment sales fell. That suggests the portfolio is no longer a simple echo of the construction cycle. Something else is driving its growth. The proof is in the profit split. In fiscal 2025, new equipment contributed 35% of net sales, but only 9% of segment operating profit. Service, by contrast, delivered 65% of sales and 91% of profit. The margin gap is a pair of scissors opening wider. New equipment margin has been compressing from 6.6% in FY 2023 to 6.1% in FY 2024 to 4.8% in FY 2025. Service margin, meanwhile, rose to 25.1% in FY 2025. That is the highest it has been on a restated basis. The arithmetic implies a model being rebalanced away from the giveaway and toward the annuity. Where's the portfolio adding units? 2 channels. First, modernization. In the fourth quarter of 2025, modernization orders rose up 43% at constant currency. The modernization backlog grew up 30% at constant currency. For the full year 2024, modernization orders increased up 12.1%. These are not new building contracts. Second, recapture. Otis is taking competitors' units onto its books. That suggests the installed base is feeding itself. It no longer depends solely on the construction pipeline. The arithmetic implies that a unit added through modernization or recapture is more profitable over its life than a unit added through new equipment. Now, consider the cash character of that annuity. In fiscal 2025, capital expenditures were $152 million. Depreciation and amortization were $175 million. The company spent less on physical assets than it recognized in non-cash charges. That is a hallmark of an asset-light service business. The elevators themselves are already in place. The cash needed to maintain the portfolio appears modest relative to the earnings it generates. That cash surplus is returned to shareholders. In FI 2025, Otis returned about $1.5 billion to shareholders, including roughly about $800 million in buybacks. The effect is dramatic. Total shareholders' equity fell to a deficit of $5,392 million. Negative net worth. That is not a sign of distress. It is a deliberate financial engineering choice. When a business generates predictable, growing cash flows from a service base that does not require large reinvestment, leverage becomes a tool to magnify returns. The hero chart for this beat would show the divergence. New equipment sales declining while service sales rise, portfolio units growing in spite of the construction downturn, and free cash flow converting at a rate above net income. But the giveaway is no longer the main event. The annuity is rented, not owned, and the cash from that rental is now being pulled forward into dividends and buybacks. The business is not broken. It has shifted its center of gravity. But that quarter-turn margin, 25.1% on service, is not as secure as it looks. The annuity is less captive than the surface numbers suggest. Independent service providers and small operators hold an aggregate of about half of the service units globally. That is roughly half the portfolio, and while Otis is the largest single service provider, the independent share is larger by unit count. Their share is smaller by value because they tend to cover cheaper equipment and lighter maintenance. But the arithmetic implies a fragmented, competitive service market, not a closed loop. The maintenance buyer is often a different party from the original purchaser: building owners, facility managers, housing associations, government agencies. Switching is real, and the future portfolio appears to depend heavily on China. China represents about 1/5 of global new equipment sales, but it accounts for over half of unit volume. The units feeding tomorrow's service base, they're likely the cheapest in the fleet, and they are disappearing fastest. New equipment orders in China fell by a high teens percentage in the most recent quarter. That suggests the supply of new units entering Otis's service portfolio is slowing, and that the units which do enter sit at the low end of the value spectrum. The annuity looks strong, but the base is narrower, more contested, and increasingly concentrated in the thinnest part of the market. The arithmetic is clear. New equipment operating margin is just 4.8%, service margin is 25.1%. But that service profit is not an asset the company can own. It is a rental earned building by building, contract by contract. Look at the balance sheet. Total shareholders' equity stands at a deficit of $5,392 million. The real value is in contracts that are rented, not owned. One building at a time. The elevator was never the product.